Welcome to the deep dive. Today, we're peeling back the headlines, looking for those hidden connections, between the fastest tech boom maybe ever, the land you suddenly can't power, chips you can't build fast enough.
And yeah, the average American who just paid, what, $50,000 for a new car. It's quite the mix.
It really is.
And what we pulled out of this stack of sources for you, it's just this perfect snapshot, really, of a bifurcated global economy. You've got this massive, almost unprecedented AI infrastructure supercycle on one side. Just feels like limitless capital spending.
A real boom.
Absolutely. But at the same time, you see this deepening crisis, escalating trade wars, intense domestic economic inequality. It's complex, a world moving at two very different speeds.
And that divergence, that split, it's captured perfectly in three key headlines we pulled out. First, you've got that pure market optimism, OpenAI sealing the deal, this custom-cheap partnership with Broadcom, stock soared.
Right.
Second, the financial engine, it's still running. Major banks kicked off earnings season looking pretty positive.
Okay, so far so good there.
But then the third one, that's the immediate visceral reality check, isn't it? The average price for a new car hits $50,000 for the first time ever.
Wow, 50 grand.
Yeah, and that massive disconnect, right, between Silicon Valley's stratospheric ceiling and Main Street's actual costs. That's exactly what we need to unpack today.
Okay, where do we start?
Let's start with that engine of optimism, the AI infrastructure supercycle, the chip race. OpenAI just formalized this giant partnership with Broadcom. What does that actually mean strategically?
Well, look, this is more than just, buying stuff. It's a foundational move. OpenAI and Broadcom, they're co-developing and deploying custom AI accelerators. And the scale. We're talking racks needing a staggering 10 gigawatts of power.
10 gigawatts, that's immense.
It is. And the strategy behind it, pretty simple, really. Cost control, custom silicon, building it exactly for their needs. That's the only way for OpenAI to really optimize its models for efficiency. And crucially, to cut down its dependence on, the big players like NVIDIA.
Right. So they're essentially getting into the custom chip game themselves, partly to cut their own costs and partly to compete head-on with the hyperscalers, Amazon, Google on the infrastructure side.
Exactly. And the market. It definitely understood the significance. Broadcom shares, they initially jumped nearly 10% on the news.
Wow.
And what's fascinating here, it's the sheer volume of demand this points to. Analysts initially thought OpenAI was Broadcom's mysterious $10 billion customer from last quarter.
Ah, okay. I remember that speculation.
Yeah, but Broadcom's president clarified, no, actually, that's a different unnamed company.
Another one.
Another one. That just tells you how desperate these large players are for customized computing power right now. It's intense.
It's just a stunning amount of money sloshing around. I saw analyst Dan Ives use this great analogy, describe the scale of this build-out as the equivalent of building Vegas in the 1950s for consumers and businesses.
That's a good one.
Can you walk us through the numbers that makes someone like Ives use that kind of, hyperbole?
Oh, the forecasts absolutely justify it. Global AI spending. It's projected to hit, $375 billion next year, 2025?
$375 billion.
And then top $500 billion by 2026. That's according to UBS projections. I mean, this is an arms race, pure and simple. And players are trying to diversify quickly.
So not just NVIDIA anymore.
Definitely not. Look at the competition.
Yeah.
Oracle Cloud, right? They're deploying 50,000 AMD Instinct MI450 GPUs. That starts in the second half of 2026. That's a significant alternative path away from NVIDIA dominance.
And OpenAI itself, they're not putting all their eggs in the Broadcom basket either, are they?
No, not at all. They have a separate deal cooking with AMD for processors needing another 6 gigawatts of power.
6 gigawatts more.
Yep. And that deal includes a potential option for OpenAI to actually acquire up to 10% of AMD shares. So yeah, they're strategically spreading their bets across multiple suppliers. Makes sense.
Okay, so that's the tech side, the spending, the competition. But there's a counterpoint here too, right? Around safety and ethics.
Yeah, absolutely necessary counterpoint to all this speed and money. The sources mention OpenAI formed an 8-member expert council on well-being and AI. This is to address that growing scrutiny, especially around how AI affects mental health, how it affects minors.
Right, that's been a big concern.
Huge. So this council, it's supposed to directly guide the development of their big products like ChatGPT and Sora. It shows that even while the spending is sky high, the, let's say, regulatory and ethical pressure is building right alongside it. You can't ignore it.
Okay. But of course, this incredible tech boom, it needs massive, sometimes volatile financing. And that leads us directly to, the underbelly of the U.S. economy, where things maybe aren't so rosy. We found this extremely skeptical economic viewpoint suggesting this AI investment might be the only thing keeping the U.S. out of a recession right now.
That's the unnerving analysis coming from Deutsche Bank. They're basically arguing that if you took away the stimulus provided by this historic AI-related capital spending, building the data centers, buying all those chips.
Yeah. All that Vegas building money.
Exactly. Without that, the U.S. economy might already meet the technical definition of a recession. It's a provocative thought.
That puts tremendous pressure on the tech sector then, doesn't it? I mean, if that AI investment were to suddenly falter or even just slow down dramatically, how exposed is the whole S&P 500? Is it all riding on just a few huge tech bets?
Well, Barry Knapp suggests the S&P 500 is currently pretty unbalanced, creating a genuine vulnerability. And the financing risk reflects this high-stakes game. You've got major players, Oracle, Meta, even CoreWeave. They're raising billions by tapping the bond market.
So taking on debt.
Yeah, basically raising huge amounts of debt now to fund these colossal data center expansions, plan to pay it back later. They're betting heavily, really heavily, on future AI profitability to justify massive present-day debt loads. It's a big gamble.
And speaking of data centers, all that demand for power and land has apparently created this fascinating new asset class, something we're calling powered land. This seems like where the physical reality of the AI boom is hitting some serious resistance.
Oh, this is a genuinely profound shift in how we even value real estate.
Yeah.
Powered land. It's not just about location anymore, not primarily anyway. It's land that comes secured with permits with utility commitments, and crucially, the actual infrastructure needed to deliver enough power for a hyperscale data center.
Power is the new bottleneck.
Power is absolutely the new bottleneck. Forget location, location, location. It's power, power, power.
I was really struck by the sheer scope of land needed here. Heinz research suggesting roughly 40,000 acres, that's nearly 2 billion square feet, just needed to support projected data center growth over the next 5 years alone.
It's enormous. And the core challenge, it's fundamentally flipped. I saw one expert quoted saying, the challenge isn't building walls anymore, it's getting megawatts to the site.
Right.
And that means these major real estate developers like Heinz, they're pivoting their entire strategy. It's now all about securing power rights. Because that scarcity, that difficulty in getting power commitments, makes the land incredibly valuable. It often overrides traditional geographic concerns now. If you've got the power, they will come.
Okay, let's shift gears a bit. From the complexities of financing and powering this domestic boom, let's look at the global stage. Because the pursuit of supply chain security seems to have turned into pretty overt economic and geopolitical friction.
Yeah, the sources definitely show that the main friction point, maybe unsurprisingly, remains the U.S. China trade dispute. And it's escalated sharply, specifically around access to critical minerals. China imposed new export controls, and they seem specifically targeted at rare earth minerals used in military applications.
Oof. That immediately flags a critical vulnerability for the U.S. defense industry, doesn't it? I mean, these rare earths, they're crucial components for top-tier U.S. weapons systems. Things like the F-35 fighter jet, Tomahawk missiles.
Absolutely critical. And the Pentagon knows it. The Defense Department is apparently speeding up efforts to stockpile about $1 billion worth of these critical minerals. That alone confirms how reliant they are and how worried they are about access.
And the U.S. reaction has been, well, pretty robust, let's say. President Trump threatening 100% tariffs on Chinese goods, even floating the idea of, quote, terminating business with China over what seemed like a snub related to soybeans and cooking oil.
Yeah, the rhetoric is definitely heating up again.
We also saw a very charged quote on this from Treasury Secretary Scott Bessent, accusing a struggling China of trying to pull everyone else down with them by using these export controls. I mean, that feels like it confirms the trade war has fully morphed into economic warfare, right? Where controlling global inputs is the weapon.
I think that's a fair assessment. It's less about tariffs on finished goods now, and more about controlling the fundamental building blocks of modern technology and defense. And this scramble for supply chain security, it's definitely not just a U.S. thing. Look at the Netherlands.
What did they do?
The Dutch government took this really extraordinary step. They basically took control of Nexperia. That's a Chinese-owned chipmaker, a subsidiary of Wingtech.
To control how?
They used something called the Goods Availability Act. The stated reason was to prevent chips essential for things like cars and consumer electronics from becoming unavailable in an emergency. So it's a direct government intervention, purely based on mitigating supply chain risk. Nationalism in chip supply.
Wow. And this kind of global uncertainty, it always sends ripples through volatile markets, doesn't it? We saw Bitcoin, for instance, slip back to around $113,000 amid all this intensifying U.S. China trade uncertainty.
Yeah, risk assets tend to get nervous when the big players start squaring off like this.
Okay, let's pivot back home now, back to the domestic front, because this is where we really see the human cost of that bifurcated economy we talked about at the start. That concept of the K-shaped consumer, it feels like it's never been clearer than in the auto market right now.
Oh, the contrast is just jarring, isn't it? On one hand, you've got the average price for a new car hitting $50,000 for the first time ever back in September. That screams affluence, or at least a willingness to finance at that really high level.
Right, someone's buying those expensive cars.
Someone is. But on the exact opposite curve, you look at auto loan delinquency rates among consumers with low credit scores.
Hmm.
They're sitting near all-time highs. The lower credit consumer is clearly profoundly buckling under the strain.
So, two completely different realities playing out.
Precisely. And this disparity, it's backed up by data like the J.P. Morgan Cost of Living Survey. High-income consumer confidence, averaging 6.2 out of 10. Pretty stable, reasonably optimistic.
Okay.
But low-income confidence, averaging only 4.4 out of 10. That huge gap, that delta, it just means the financial experience of living in America right now is profoundly different depending on which income bracket you're in.
And are we hearing any warnings from, say, the big banks about this divergence?
We absolutely are. Clear warning bells for the very top, actually. Jamie Dimon, the CEO of J.P. Morgan Chase, he explicitly cited recent auto company bankruptcies. Companies like First Brands and this subprime lender called Tricolor Holdings, which actually cost J.P. Morgan $170 million in charge-offs.
Ouch.
Yeah. Dimon called these early signs of excess in corporate lending, excess that he thinks has been building up since maybe 2010, 2012.
I love Jamie Dimon's quote on this, actually. It really crystallized the fear. He warned analysts, and I'm quoting here, "When you see one cockroach, there are probably more."
Huh. Yeah, that's a classic Dimon line, isn't it? Unforgettable.
What exactly is he telling people to look for with a line like that? What's the underlying message?
He's urging serious credit scrutiny. Those bankruptcies, they aren't just isolated incidents in his view. They're signals. Signals that the lending environment has maybe been too loose for too long, especially in those subprime or less protected corporate areas. So if you see one company fail because credit conditions are tightening or their business model was weak, it's a strong sign that the underlying weakness is probably systemic and more failures are likely to follow. Watch out for more cockroaches.
Got it. Okay, finally, let's look at the policy environment, which right now seems defined by gridlock and these approaching financial deadlines.
Yeah, unfortunately.
Hmm.
We are now on day 14 of the government shutdown. And the human cost is definitely becoming more visible. Air traffic controllers, for instance, they're still working, obviously, essential personnel.
Right, they have to.
They have to. But they just received their first partial paycheck.
Yeah.
And they face missing a full check entirely on October 28th if this shutdown continues. And these shortages, by the way, they've already led to actual flight disruptions. Places like Burbank, Nashville have seen delays directly linked to controller staffing.
And the political messaging around the shutdown itself is causing its own friction, isn't it?
It is. Apparently major airports, big ones, in New York City, Chicago, Portland, they refused to air a video from the DHS secretary that blamed Democrats for the shutdown. They cited their own policies against partisan messages and even concerns about violating the Hatch Act, which restricts political activity by federal employees.
Interesting. So the shutdown isn't just stopping things, it's causing active conflict.
And it's causing permanent damage, too. We're seeing official layoff notices go out now, RIFs, reduction in force notices.
Yeah.
The administration issued about 4,200 RIFs across at least 8 different departments.
Wow, 4,200 jobs.
Yeah. And notably, this included cutting the entire 83-person staff of the Community Development Financial Institutions Fund, the CDFI firm.
Oh, I know them. They do important work.
They do. They support lending in underserved communities, and critically, that fund has always had strong bipartisan support. Cutting it entirely, that really shows you the depth of the current gridlock and dysfunction.
And the gridlock is messing with crucial data releases too, right? Like the Social Security COLA.
Exactly. The cost of living adjustment, the COLA announcement for 2026, it's delayed. It won't come until October 24th now, simply because the shutdown postponed the release of the key inflation data, the CPI, that it's based on.
Do we have any idea what it might be?
Well, experts are estimating, based on the data we do have, that the CLA will probably land somewhere in the 2.7% to 2.8% range. but that financial certainty for millions of seniors, it's currently on hold, thanks to Washington.
Okay, what about the Federal Reserve? Any signals from them amidst all this?
Yeah, on the monetary policy front, the Fed is giving some signals of a potential shift. Chair Jerome Powell suggested the central bank is getting near the end of its balance sheet reduction process, what we call quantitative tightening, or QT.
Okay, so they might stop shrinking their balance sheets soon, meaning they'd stop selling off their bond portfolio, which reduces some pressure on the money supply.
That seems to be the implication. Powell also hinted pretty strongly that interest rate cuts are now firmly on the table. He specifically noted that the labor market has softened pretty considerably. That suggests policymakers are maybe shifting their focus now, balancing the risks of inflation against the growing risks to employment.
Interesting. Okay, now for maybe the genuinely actionable insight for you, the listener, on the tax front. Because despite all the government gridlock, the IRS did manage to confirm the tax brackets for 2026. And it apparently creates a potentially huge opportunity for investors. They raised the threshold for the 0% long-term capital gains rate.
Yeah, this is actually a really significant finding buried in the details. For 2026, single filers can earn up to $49,450 in taxable income.
Okay.
And married couples filing jointly can earn up to $98,900 and still pay absolutely 0% tax on their long-term capital gains.
0%. Up to nearly $100 for couples.
0%. And experts are calling this a significant opportunity for specific financial planning strategies. Like, say, if you're doing a Roth conversion or maybe looking to do some tax loss harvesting, you could potentially rebalance your taxable investment portfolio without triggering a big tax bill. Yeah. It's a rare chance, really, to move assets around tax-free within those income limits. Something worth looking into.
What a truly dense set of sources we had today. We really started with this monumental investment surge, didn't we?
Yeah.
The custom chips, this whole new asset class of powered land, hundreds of billions committed to AI infrastructure. It's a story of just incredible accelerating capital expenditure.
Absolutely, billions, maybe trillions, flowing into this vision of the future. And yet, we ended with the immense strain just beneath that surface boom. Escalating trade wars, a government locked in shutdown, bank executives spotting cockroaches in corporate lending,
Yeah.
and the consumer economy clearly fracturing into two separate realities. It's striking how the massive investment in AI almost requires geopolitical stability and smooth supply chains to work. Yet the boom is happening during a period of immense fragmentation and rising global risk. It heightens the stakes enormously.
The core conflict here really seems to be about concentration versus fragmentation, doesn't it? We saw that concentration of capital, Rockefeller capital, raising money from powerful family offices, hitting a $6.6 billion valuation, the big banks beating earnings.
Right, capital consolidated.
Exactly. That concentration of wealth and power is set against this backdrop of global fragility, trade wars, and the rising cost of just everyday goods for the average consumer.
It really does raise a powerful question for the decade ahead, doesn't it?
Mm.
Especially when you look at these AI mega deals, these vertically integrated ambitions, and the simultaneous political reaction trying to secure supply chains.
Like the U.S. stockpiling rare earths or the Dutch seizing Nexperia.
Precisely. So the question is, given that rapid push toward vertical integration in AI, where companies want to own everything from the custom silicon right up to the consumer hardware, and the simultaneous political desire for de-risked, maybe more nationalized supply chains, will the next decade be defined more by that vertical corporate control or by horizontal geopolitical fragmentation?
Vertical corporate power versus horizontal political splintering.
Yeah. I mean, if you own NVIDIA or Broadcom stock, you're essentially betting on vertical control winning out. If you're more focused on geopolitical risk, maybe you're hedging against that fragmentation. It's a fundamental tension, something to certainly keep an eye on going forward.